At Charlotte, we believe nothing is more powerful than what's next. Welcome to the university where potential turns into action, opportunity turns into success, innovation turns into transformation, and leaders drive progress in Charlotte and beyond. Here, barriers are made to be broken, and community is the foundation for greatness. At Charlotte, your chance to create the future begins. What happens after that is up to you. Charlotte, shape what's next.
Good afternoon. I'm Artie Zalanti, and I serve as Department Chair and Professor of Economics in the Belk College of Business at UNC Charlotte. I'm pleased to welcome you to the North Carolina Economic Forecast. Over the years, we've been thankful to our friends in the business community for providing essential funding for this event and the research that underlies the presentation. Sponsors help keep this quarterly event complimentary for students, alumni, and the business community. For sponsorship information, email us at belkrsvp@uncc.edu. If you have questions, please submit them via chat at any time. We will have a question and answer period following today's presentation. And for those of you on Twitter, you can join today's conversation by using hashtag #NCForecast. We look forward to seeing your tweets. And now it's my pleasure to introduce my colleague and our speaker, Dr. John Connaughton, Professor of Financial Economics in the Belk College. John joined the Belk College faculty in 1978 and became Director of the Economic Forecast in 1981, with the first quarterly presentation 40 years ago this year in December 1982. For over 40 years, he's been covering recessions, expansions, everything in between by interpreting the data and sharing his expertise on where North Carolina's economy has been and where it's going next. And John, I know we're all looking forward to your presentation in these, let's say, interesting times that we have here.
Thank you, Artie. Let me go ahead and share my screen here. And good afternoon to everyone. Certainly glad that you could join us today. You're right, Artie, these are interesting times, and for many folks in the audience, this is a period of time that is unlike anything else that they have experienced. It has been over 40 years since we've seen inflation this high, and it's been that long since we've seen the Fed essentially try to navigate us into a recession, if you will, or at least an economic slowdown. We'll see how that turns out in a couple of months. Today, we're going to talk about a presentation. Let's go ahead. We're going to take a look at the outlook for North Carolina in 2022, the remainder of the year. Then we'll look at the outlook for 2023. We're going to spend some time talking about inflation and the trends and essentially look at what the Fed has to do today compared to what they did in the 1970s in order to curb this inflation. And then finally, we'll talk about the prospects of recession, either at the end of this year or potentially into 2023 as well. All right, so let's first of all start off with what's going on in the economy this year and where we think it's headed for the remainder of this year. So the first two quarters, as you can see, were negative, down 0.9%. That compares to a 1.6% decline for the U.S. economy, and down about 0.5% in the second quarter compared to what the U.S. dropped by 0.6%. So we're pretty much in line with what's going on with the U.S. The second half of the year, we expect actually to achieve economic growth. So far, the U.S. GDP, the Atlanta Fed U.S. GDP tracker has GDP positive for the third quarter. It's at this point, so I think we'll probably see a positive third quarter. All bets are off for the fourth quarter. The Fed has more work to do. We know they're going to be raising rates as the year goes on. And so it's going to be kind of interesting to see. But right now, it looks like we'll have modest growth, below trend, if you will, in 2022 fourth quarter. On a sector by sector basis, it's kind of interesting. We've had a very, very mixed response in terms of the sectors. For those of you that are joining us for the first time, let me give you a little bit of heads up on how this chart works. This is sort of a combination of a bar chart and a pie chart put together. So if you look at the horizontal axis, and I'll go up to this one information here, the height of this represents the growth rate for that sector during the year in terms of GDP or output. So in this case, information grew by 8.6%. The vertical axis provides us with the pie chart information. If you add all these up, they'll equal 100%. So in the case of information, it grew by 8.6% and accounts for 5.4% of North Carolina GDP. Resulting bars here, these rectangles, give you the importance that each sector had in the overall growth of the state's economy. So bigger boxes, if you will, had more important impact on the state's economic growth. And so you can start to see that, business and professional services really is pretty large, as is the government, in terms of the overall impact that it had on GDP growth. The other thing that's interesting is we start to see some sectors that show decline, like retail and wholesale trade. Construction has been off this year, and mining is off as well. Mining is a commodity that's been up and down as some aspects of the economy have had supply chain issues, and it has affected our mining. Mining is not a big issue here. It's only 0.1% of the state's GDP. But as you can see, manufacturing accounts for our 17%, the two, durables and non-durables, 17% of GDP. So it's an important pair of sectors. On the employment side of things, and this is going to be a story that's going to be themed throughout this entire presentation today, and that is the disconnect, and I'll just slide on back here, between GDP growth and some of the sectors that are struggling in terms of growth, some that are doing okay, and employment, where we see a 3.5% growth rate, and adding 162,000, a little bit over 162,000 jobs between December of 21 and December of 22. And while we see a few sectors declining in output, what we see is virtually every sector, all 14 sectors, increasing in output. This chart's similar to the one in the previous page, and you can see that business and professional services and government have the big rectangles, and therefore they're adding the most to the overall growth rate of 162,000 jobs. But the big thing is it's almost double, the employment growth rate is almost double that of the GDP growth rate. And that's part of the disconnect that we're having in the economy right now, between what's going on in GDP and what's going on in the labor market. For 2023, the picture is pretty mixed. We think, and that 6.9% is wrong. I apologize for that. It's overall at 1.4%, 1.5% growth rate for the year. We expect every quarter to exhibit growth at this point in time, but a lot of that will depend on what the Fed does with interest rates in 2023. Right now, it's unclear. They really haven't provided any forward guidance for 2023. And so what we need to be looking at here is, in terms of adjusting our outlook for 2023, is what we start to see the Fed doing in January and February of 2023. Overall, we expect, and this is the annual growth rate, is 1.8%. So for the year. Overall, we expect every sector to show modest growth during the year. Some of them, again, business and professional services is pretty good. Finance, insurance, and real estate is going to grow at a pretty good clip next year compared to this year. Both manufacturing sectors are supposed to be up. So it's going to be a less volatile year than what we had in 2022, as we start to more evenly match the supply and demand, aggregate supply and aggregate demand in the economy. And we'll talk more about how we're going to do that, how we're going to accomplish that in 2023. And here's the employment. Big difference here. We're starting to see the output growth and the employment growth start to pair up together again. Instead of 160,000 plus jobs, next year we expect only about 74,000 net jobs to be created between December of 2022 and December of 2023. Again, most sectors, all sectors will experience growth in employment next year. Information, again, will have the biggest growth, biggest increase in employment, 5.7%. However, while it makes up 4 or 5% of GDP, it only makes up less than 2% of employment. Very high productivity sector. Same thing with finance, insurance, and real estate. It's going to grow about 1%, but from an employment standpoint, it only makes up 6% of employment. But as you can see back here, it makes up 18% of GDP. Again, a very high productivity sector. As far as the unemployment rate is concerned, the blue line is the US seasonally adjusted line. The green line is the North Carolina seasonally adjusted line. what we're looking at here is the U.S. rate is up now in August. It's 3.7%. Our July rate was 3.4%. We expect it to tick up slowly over the remainder of 2022, end of the year about 3.6, 3.7%, and wind up with just under 4% by the end of December 2023. Kind of putting everything in perspective after basically 2.5 years. This should be 22. My bad. But after 2.5 years, looking back to 2019, GDP is about 4.9% higher in the state now than it was before this all began. We have 53,000 more jobs, and the unemployment rate is only 0.3% higher. That's probably statistically not that significant. And as a result of that, the COVID recession is over, and we're back where we were. And in fact, we're higher. Over the last 2.5 years, we've averaged a little over 2% growth per year from where we were before this all began in terms of GDP. So what are our concerns going forward? Well, we've got these known knowns, and we've got continuing supply chain issues. Supply chains got broke during COVID. A number of them have not recovered. In addition, we've had a number of supply chain issues crop up that were not necessarily damaged by COVID. We really have a serious supply side issue, and that's really right now the main cause of inflation. We started with demand pull inflation or demand side inflation because too many dollars chasing too few goods, but that's pretty much over at this point. Certainly it's been minimized compared to where it was in 2020 and 2021. But right now what we're dealing with is real supply chain issues. They keep popping up here and there in various industries. I mean, one out of the blue was the baby formula issue that came up earlier this year that still is not resolved. And we still have problems in trucking, just a series of these supply chain problems that are handicapping the economy going forward. We also know we've got an inflationary problem, and that's not going to go away anytime soon. It's a stubborn problem. And even though the Fed has been serious about it now for the last 8 months or so, it's still a problem trying to get this thing turned around very, very quickly. We've seen very little change. It's not clear we've actually reached peak inflation at this point in time. So we'll have to wait and see what happens, but it's going to be a troubling problem in the economy going forward. We are still deficit spending going forward, and that's a problem. In addition, we have a bunch of unknown unknowns, things that we really don't know what's going to happen. We've got Omicron and a new variant. We don't know if it's going to this fall jump up and bite us again like it did last year. That's an unknown. Ukraine, after the speech earlier this week by President Putin. It is really troubling, and these are these exogenous shocks that really create problems in the economy. We've got Fed tapering, which is reducing their balance sheet. It's unclear how that's going. And finally, we have Fed interest rate policy, which right now seems to be very hawkish, but that can turn on a dime if and that can be problematic going forward. So let's talk a little bit about inflation, because that's really what the cause of the economic problems that we're having right now and that we're likely to have going forward in 2023. So there are three kinds of inflation that we talk about. We have demand pull inflation, and that's when demand for output exceeds what the economy can produce. You'll sometimes see that referred to too much money chasing too few goods, and that's the act of buyers bidding prices up, and they bid prices up. And then part of what has generated this is the stimulus checks and the amount of government spending that has taken place since early or mid-year 2020. In addition to that, we have something known as cost push. This is the demand pulls on the demand side of the economy. It really has to do with what households are doing. Cost push is the supply side of the economy, and prices get pushed up by increases in costs, raw material cost, etc., availability of factors of production, regulations, the list goes on. And we've recently had work disincentives that have caused labor shortages in lots of industries, and those all generate cost push type of inflation. The initial part of inflation that we had back in the early months of 2021 were predominantly demand pull inflation, at least for the first 6 to 9 months. But lately, we've been experiencing cost push inflation. Demand pull is not as big an issue as cost push. But after a year and a half of increasing inflation, each and every month, inflation has been ticking up. What we get into is this third type of problem, and that's an expectations problem or embedding problem. And that is both consumers and producers expect prices to be rising, and therefore they are not constrained in terms of either increasing prices, even if their costs don't go up. It's an opportunity to raise prices because it's expected. And on the demand side, we don't see consumers pushing back when prices rise. They say, well, that's just the world we live in right now. And so we're in that expectations or embedded inflation period at this point in time, as well as a cost push problem. So let's take a look at the inflationary pressures that we faced back in the 70s, because that's the last time we really had an extended period of inflation, averaging almost double digits for the entire decade. We had a slew of new domestic programs in the war on poverty in the Johnson administration in the mid-1960s. The advent of Medicare, Medicaid, aid to families with dependent children, which we sometimes refer to as welfare, food stamps, which is the SNAP program today, and 12 more safety net programs that were all pushed through Congress in the 1960s and initially had modest impact on inflation and government spending. But as these programs ramped up and people started to access them by the 1970s, we clearly it was impacting the government deficit going forward. Second thing we had was Vietnam War and the buildup in the late 60s. And then finally, we had something known as the Nixon shock. And I encourage you all to Google Nixon shock and watch the YouTube video of it. It's quite fascinating. We talked today about our politicians, and there's nothing new going on today compared to what was going on in this case, in this video in 1971, when he announced a 90-day wage and price freeze, and then later continued controls and then guidelines on wages and prices, an across the board 10% import tariff, and the removal of the United States and basically the rest of the free world off of the gold standard. We had fixed exchange rates. Almost all currencies were either backed by gold or tied to the US dollar and therefore backed by gold. And when we left the gold standard in 71, it really created a period of adjustment. We also had cost push factors. We had the 1973-74 gas shortages and the massive gas lines. We've shown some pictures of those in presentations past. And we also had a similar situation in 1979 with another gas shortage. These were prices were controlled at the time, but availability became a problem, and that generated cost push inflation as well. Here's kind of the decade of the 70s. Started off fairly modestly, but remember in 1971, after a 5.8% increase in 70 and a continued 4.3% in 71, Nixon announced a wage and price and took us off the gold standard. You can see what happened after that. We got immediate escalation up to a double digit, stayed there for a couple of years, got a little bit of respite here. But then by the end of the decade, when Volcker came in as Fed chair in 79 and again in 1980, double-digit rates of inflation during those years, which led to a rather draconian Federal Reserve policy in 1980 that essentially ended inflation for 40 years. Okay, so today's inflation pressures, what do we got going on today? We have domestic spending, and while the Fed is, as we speak today, putting the brakes on, Congress and fiscal policy is still deficit spending. And basically stepping on the accelerator while the Fed is stepping on the brake. It's kind of a rocky ride, to say the least. We've had stimulus checks in the past that have been handed out. We have the enhanced unemployment payments. We had payroll protection. We had child care credits, and we had the SNAP benefit program upgrade. That's food stamps. And while Congress did not authorize a higher payment when they changed the caloric balance of the program, the benefits had to go up in order to achieve, or for folks to be able to purchase that upgraded quality of food. Here's an example of the coronavirus congressional funding all the way through the infrastructure bill, which was passed earlier this year, I should say. And these total 7.1 trillion. These are not funded. Now, not all of that has been spent. Let's be clear about this. Probably about just a little under 6 trillion has been spent so far. So a lot of this, some of this spending will take place in later years. Here's an example of the stimulus checks, family of 3, 2 adults, 1 child. The sum of stimulus checks between the spring of 20 and the spring of 21, when inflation really got going, was about $9,000, and 80% of households were essentially eligible to receive those checks. And so a lot of these checks went out. Some families got a lot more than this because they had more kids. Others got less because they were either individuals or had no kids in the household. And here is starting in, as you can see, in January and February of 2021, inflation is still under 2%. By March, it raises above 2%. And then you can see this steady increase, a little bit of slowdown late last year. And then during all of 2022, the end of 21 and all of 2022, we've seen an increase. We've seen a slight drop in it the last couple of months from the peak of 9.1%, but we're still looking at 8.3% as of August of 2022. Okay, today's inflation pressures, and we've got cost push. We've got declining labor force participation rate. We have shifting demographics, which are causing this. And we'll show a chart about that in a minute. We've had extended supply chains that have broken and have been disrupted, that have caused wide disparities in industry's ability to meet the demand side. We've expanded regulations, particularly in the energy sector, but also in banking and a few other sectors, which have caused cost push inflationary pressures to exist. Obviously, we've had COVID issues, although most of those are over today. And energy prices and energy availability is still an uncertainty and problematic going forward as it relates to the cost push side of inflation. So here is the labor force participation rate. I just kind of keep, this is over from 1976 all the way through to today. And so back in the middle of not the 1970s, when the baby boomers first started showing up and wanting to work, we've seen a steady decline because there's so many of them, 76 million of them. And that when they show up in the workforce, you start to see this steady decline, steady increase in labor force participation rate, peaking right around the turn of the century here, moving up from the high 61% range to essentially 67%. And since then, we've started to see, we've started to see a decline, a modest decline in the early part of the century, and then a more steep decline since the Great Recession of 2008 and 9. And then we see the big drop as a result of COVID, and then slowly starting to claw our way back. Truthfully, if we continue this line on, we would still be probably less than 63% in terms of labor force participation today, but for COVID. So we're not really that much different from where we would have been had we not experienced the impact that COVID had on the labor force participation rate. And here's what's going on. I know this is a busy chart. This is a chart out of the 2020 census, 2020 census. And it is essentially the number of people in millions in each 5-year age cohort. So what I want to focus on is not any of the blue lines, but these candy stripe lines. And the first one I want to focus on is the people that in 2020 were between 60 and 64 years old, because that's the group that's getting ready to retire. And in some respects, they got pushed forward in COVID. Okay, there's no question about that. And there's just under 21 million of them. Okay, and what we have back here in the 15, 19-year-olds in 2020 that are the ones that are going to start to enter the labor force is essentially a group that's roughly the same size. Not the same skill set, not the same work habits, but roughly the same size. Going forward, though, and spin the clock ahead another 5 years from where we are today, and the 55 to now 59-year-olds 5 years from now will be 60 to 64, and they will begin the process of retiring. There are 21.6 million of those, and unfortunately, there's virtually a million fewer in the 10 to 14-year-old range that will start to replace those folks. And you look at this, it's very similar, and this, it's again smaller and smaller. So this problem of replacement labor being problematic in generating lower labor force participation rates is not something that's going to go away in 5 years or 10 years. It's going to be with us for the next 2 decades before we start to see a change. And then a lot is going to be determined by fertility rates 5 years from now and 10 years from now. Now, compare this to 1980. All right, so here come the baby boomers. All right, these were folks that were born in 20 years earlier in the 50s. Here they come. All right, and this group in 1980 was 21 million, and that's replacing a group that was only 10 million. So you start to see why labor force participation rates were rising. Okay, so that kind of shows you the difference in terms of what we're facing here in terms of replacement versus what we faced 40 years ago when the baby boomers were entering the labor force and replacing much smaller groups. There's also one other thing that's come out that's recently that has been extremely concerning for me, and that is labor productivity. And this is a very concerning chart, and I think that it's something that not only do we need to talk about, but we also need to a little bit more needs to be focused on it going forward. The first quarter, and labor productivity is real simple. It's output, GDP, output per worker hour. So it's just a real simple formula. The numerator is output, the denominator is an hour of work. How much output does a worker produce in an hour? And what we saw in the first quarter of 2022 was a decline of 7.4%. Now, this chart goes only back to 2020, and we ain't got nothing like that. In fact, you have to go back all the way to the second quarter of 1947 before you see a similar decline in a quarter in labor productivity. That is very troubling. And further troubling is the fact that in the second quarter, while it recovered a little bit, it was still down another 4.1%. So that's a double-digit percentage decline in productivity in the first half of this year, which goes a long way into explaining why GDP was down in the first and second quarters of this year. Okay, you're hiring workers, the labor market's working fairly well for workers, but as it turns out, for a variety of reasons, the production side, the productivity side has been very much off in the first half of this year. All right, so let's take a look at how the Fed behaved in the 70s, the lessons maybe we learned or didn't learn, and how they're behaving so far in the 20s. All right, so confusing Fed jargon, and that's, when you watch the Fed, you get into all kinds of issues here. They talk about short-run inflationary expectations on one hand, they talk about long-run inflationary expectations on the other, and they talk about the neutral rate or the equilibrium rate. And of course, they also talk about issues of COVID and energy prices as well. So, I'm reminded of a quote that Milton Friedman, a Nobel laureate in economics, once said back a few years ago in 1963. And he said, inflation is always and everywhere. So it doesn't matter what country you're in. Inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than an output. So thinking back on that, and I've already criticized, if you will, the Congress of the United States for spending so much money during the COVID recovery. I've done that. I've talked about it today, and I've talked about it in previous. In and of itself, that would not have been inflationary unless the Fed accommodated it. And that's where the money printing came in. And so that's what really produced it. Yes, it was the spending. Yes, it was putting dollars into people's pockets and government spending on programs that generated the demand pull inflation. But that spending might not have taken place in the same level and in the same environment had it not been for the Fed's accommodation by printing the money to make it possible. And here's a troubling chart. This goes all the way back to 1960. M1 is the most liquid form. M2 is a less liquid form because you can't convert it to money as quickly as you can M1. M1 could historically, M1 up until April of 2020, M1 included coin and currency, demand deposit balances at commercial banks, and traveler's checks. Okay, I know most people don't know what traveler's checks are. M2 was M1 and basically savings deposits, money market accounts, etc., because they're less liquid. You can't write a check, you can't pull money out of your pocket if it's in a savings account. You got to go to the bank and get it. Now you can transfer it to your savings account. But what I want you to look at is not so much this line and this big jump, because this big jump was really a change in definition. In April of 2020, the Fed allowed unlimited withdrawals from money market accounts, and that basically converted them from, before they were a monthly limit on how often you could go into your savings account and pull money out of it. It was not relevant, okay? But because of COVID and the concern that the Fed had that people would not be able to get to their assets, they lifted that regulation, and as a result of that, time deposits and money market account, savings deposits and money market accounts basically became M1. All right, what I want to focus on here is the exponential growth of the money supply, whether it's M1 or what would be the new definition of M1, because M2 is basically the same now as M1. There's very little differences you can see between them, and you can see this growth, and then all of a sudden this massive growth after 2020. And it's tapering off a little as we speak, but it really is, this is trillions of dollars. Okay, this is $6 trillion of growth in the money supply in basically 2 years, and that has been the underlying driver of demand pull inflation. Now, in theory, the neutral interest rate is the rate at which monetary policy is neither stimulating nor restricting economic growth. It's a rate that keeps output growth around its potential rate with full employment and stable inflation. And the Fed really, sometimes you'll see it referred to as the equilibrium rate. So how does the Fed know what it is? Well, it really doesn't, but it has estimates. And basically what it does is to ask the board members and the Federal Reserve district presidents what they think the neutral rate is. And then they take the mean of that. Basically right now, the FOMC back in 2012, when the first time they began publishing it, they pegged it at 4.25%, but in July of 2022, it stood at 2.5%. I suspect it's considerably higher now. It's probably in the mid 4% range again. At which point in time, it should not be stimulative, nor should it be restrictive. The problem is that if we look back at what the Fed was doing during those years where we had enormous inflation, you can see that the orange line is the consumer price index. That's the one we always look at to measure inflation. The blue line is the federal funds rate. And you can see that, in the late 60s and early 70s, the federal funds rate was above it and it was pulling inflation down. But you see what's happening here is the Fed is, okay, inflation's coming down. Let's ease off interest rates and get them down again. And all that does is re-stimulate inflation and it rises up again. Again, we're tracking along all the way up to basically this peak in 1980. And then Volcker comes in and basically says, okay, that's it. We're done with this. We're going to get out in front of this. We're going to have serious real interest rates when the Fed funds rate is a couple of points, 4 or 5 points in this case, above what the inflation rate is. And you can see it really dramatically dropped the inflation rate down below 5% for the first time in a decade. And unfortunately, that came with the price of a rather severe recession in 1982. Hopefully the recession won't be as severe, and I don't think it will be, even if the Fed gets very, very hawkish about driving interest rates up to curb the inflation. And that's because of the strength, just the overall strength today in the labor markets, which didn't exist in the 80s. All right. And here's what we're dealing with today. Here's the CPI. This is when the Fed and the administration is saying, oh, don't worry about it. Excuse me, right here. Don't worry about it. It's only transitory. And so they didn't change rates while it jumped up from below 2% to over 5% and stayed there while the Fed did nothing. And then it started ratcheting up, and it's only been since the January of 2022 that the Fed has started to raise rates. But you can still see an incredible gap. Yes, that's right. It's roughly after yesterday's action, it's roughly 5 percentage points difference between the federal funds rate and inflation. That's a negative 5% interest rate. Okay. Now, where does Jerome Powell stand? Because he seems to be the guy that's holding all the cards in this. And Powell noted in a recent Cato Institute speech, and while it's not in here yesterday, he also said this yesterday in his press conference, that one of the lessons learned from the period of inflation that former chair Paul Volcker inherited is that failing to bring down inflation only entrenches inflation expectations, which in turn makes it harder to get it under control. So what he's suggesting is the prior record of failed attempts to control inflation resulted in higher costs to bring it down again. If we just slide back here, you start to see what he's talking about. We really never got a handle on it and ended it during this period. It took this type of action to drive it down, and that type of action, Fed funds rates and mortgage rates, approaching 20%, basically created a really serious recession in 82, where the unemployment rate in the country rose above 10%. And so that's what he's saying here. He said that in August in Jackson Hole's speech. He said it in the Cato speech, and he said it yesterday in his press conference. All right, so where are we with the Fed? So here's what's been going on this year. In March, they began raising rates by 25 basis points first, and then 50. We've had now 3 successive 75 basis point increases. The federal funds rate now is targeted between 3% and 3.25%. We expect the next 2 meetings of this year to see 50 basis points in each meeting. I would be surprised if that doesn't happen. I'd be very surprised. And so by the end of the year, we'll be looking at essentially achieving what they think might be the neutral, or what they have been saying this fall is the neutral rate, where federal funds is between 4 and 4.25%. The question is, what do they do after that? Okay. And that's really going to lead to whether or not we're going to wind up in a recession or not. So let's go through this pretty quickly. So here we go. These are the 5 decades of recession: the 70s and the 80s, 90s, the aughts, and the teens. All right, so the energy recession we had was pretty significant. It lasted 16 months. Short recession in July of 80, and then the 81, 82 recession I talked about earlier, 16 months, peak unemployment rate north of 10%. A couple of mild recessions in 90 and 2001. Then the Great Recession, because of the housing bubble and some really bad actions that were taken on the part of lending companies in the early 2000s. That lasted 18 months. Peak rate again pushed 10%. And then finally, the 2-month recession that a lot of us aren't clear is really a recession, because the economy didn't generate it, government generated it, and it went away as soon. We dropped 31% in GDP in the second quarter, and then we shot up 33% in the third quarter after the shutdown was over. All right, so here are the causes of those. The 73 was the Arab oil embargo. In January of 80, that recession was again oil related, the Iranian Revolution, but also Fed policy. Fed had some restrictive policy at that point in time, which caused it. Finally, the big one, which was all Fed policy, that was the Volcker days. 1990, we had the Iraq invasion of Kuwait and Fed policy in response to that. March of 2001 was the dot-com bubble and the impact that Y2K had on reducing investment in 2000 and 2001 after 2 years of really significant investment in tech, if you will, for most companies. Finally, the gas price and housing bubble one. A lot of folks forget the 2007 that started in 2007 as a result of the last time we had $4 gas in the summer of 2007. But the real bad, that would have just generated a recession that was similar to 2001 or 1990. The second shoe fell in the fall of 2008 when the housing bubble finally collapsed. Okay, so recession uncertainty. Consumer confidence, we really don't know where that's going. It's not been good the last couple of months. We have the continuing expanding supply chain issues. And even after we focus on like the baby formula, we still don't solve them anytime soon. We still have serious shortages, particularly the powdered baby formula. Inflation, we're not sure we're getting it under control. We're not sure we've hit peak inflation. We think we know something about Fed interest rate policy, but honestly, we don't. It's unclear what they're doing going forward and if they'll maintain this hawkish posturing. Fed tapering, that's the reduction of the Fed balance sheet. We'll talk a little bit about that in just a second with the chart. Deficit spending continues. As I say, even to this day, we see the Fed trying to slow the demand side of the economy and Congress continuing to pass new packages with new spending that allegedly they say is paid for, but it's not clear that it is. Finally, we have the threat of another spike in COVID and a new variant. And lastly, the uncertainty that's surrounding Europe, Ukraine. Europe is going into recession as we speak. It's not going to be pretty in Europe because they have serious supply side issues with energy. You know, they are definitely going to head into recession. It's not clear that we will at this point in time. So here's the consumer confidence for the last year. As you can see, it's been steadily falling. It's getting pretty close to neutral at this point in time. These are index numbers, and so we're getting pretty close to neutral at this point in time. And you know, we don't know, given what is likely to happen in the next few months with relates to Fed policy, unemployment. When the third quarter GDP comes out, we could see this drop again. Here is again that same chart I showed before. The Fed is starting to deal with this, but they're still far below the consumer price index number. Here's an interesting chart. So this is the last known annual, that's the August 2022 to August 2021 price hike, or CPI increase 8.3%. If you assume that we've reached peak inflation and that inflation will continue, the Fed's been extremely successful and will only continue at like a 4% annualized rate over the next 4 months. So much has already been baked in that we're going to see numbers for the next 4 months that are all in excess of 7.5% for the year over year for that month inflation. So, you know, inflation is still going to be over 7.5% at the end of this year, 4 months from now. Here's an interesting statistic. Since August of 20, when the economy recovered from COVID, to August of 2022, prices have gone up a total of 14% on average. So on average, American families are paying 14% more for what they bought, or what they buy in August of 2022 compared to what they paid for it in 2020. 14%, 7% a year. Unfortunately, wages have gone up by less than 10%, slightly less. And so what that basically means is you can buy 4% less stuff today than you could 2 years ago, or you're 4% worse off than you were 2 years ago. That's the ravages that inflation creates. Okay. All right, so federal interest rate policy, their resolve. So the current federal funds target is 3% to 3.25% as of yesterday. Got 2 more meetings. The December rate, as I said earlier, is between 4 and 4.25%, but the inflation rate is going to be closer to 7.5%. So they're still going to be looking at the end of this year, negative 3.25% interest rates. We're still not getting out in front of inflation. And here is the Fed balance sheet, and what we're looking at here is a kind of a strange situation where we started to see it taper. In April, it was 8.9 trillion. In September, it's 8.8 trillion. So they've come down a little bit in their balance sheet, but it's still pretty significant. $9 trillion is the Fed balance sheet. You can see right here what I was talking about earlier in terms of the Fed's accommodation of fiscal spending. This is the initial COVID set of spending, and this is the second round of spending all the way through the infrastructure bill. Okay, so the federal balance, the current balance sheet is 8.9 trillion. It's projected, they projected that they would basically cap the can't think of the term, brain fade, sorry, the trimming of the balance sheet to 47 billion, reduction in June, July, and August for those 3 months. But as of June 1, these numbers are upside down. It was $8.922 trillion in June of 2022, and today that balance sheet is 8.915, or a reduction of only $7 trillion when they could have reduced it by over $2 trillion, and they didn't. The current plan is to raise the cap for reducing the Fed balance sheet from September of 22 to December of 23. So that's a year and a quarter, by almost 100 billion a month. Okay, so the projected decrease over that period of time is 1.6 trillion. And you know, at the end of the day, what they're hoping for is to trim that balance sheet down to 7.2 trillion by the end of 2023, and that will be helpful. Now, whether they do it or not, or whether they are, you know, again, these are caps. This 95 billion per month reduction in the Fed balance sheet is a cap. They're not going to do more than that. The question is, will they continue to do, or will they reach that? So far in the first 3 months of this plan, they haven't even gotten close to the cap level. All right, so historic length of recessions. I guess if I'm talking about the length of recession, it must mean I feel fairly confident we'll see something this in 2023. And I got to finish this up in about 30 seconds here. As you can see, over time, recessions, the Fed's got much better at managing these recessions and getting them out of, getting us out of them. I think that we'll probably have a mild recession in 2023. And as a result of that, it will probably only last in 2023, and by 2024, we'll be out of it. Okay, so key takeaways. Exogenous energy shocks matter. They hurt the economy. Fed policy matters, and they're resolved going forward. Will they remain hawkish and really get in front of this inflation? Demand side versus supply side inflation. The Fed can only deal with the demand side. They can only affect consumer and business demand. They can't do a darn thing about the supply side and the supply shocks that we're having. The wealth effect is the stock market is correcting. People feel less wealthy, their 401ks go down, they will spend less money. As we've talked before, when the NBER finally decides where we're in a recession in 2022, probably a 50% chance. I think it rises to 75, 25, and 23. Keys to watch going forward: Fed tapering and interest rate policy. Will they remain hawkish? Are energy prices going to start to rise? Because we're starting to see them tick up a little bit. All the trouble in Europe and the effect that it's going to have on the European economy, particularly this winter. The September inflation number comes out October 13th. The next FOMC meeting is the 1st and 2nd. So at 2 o'clock on the 2nd, we'll find out if they're going to raise it by 50 basis points. The end of October, we'll see the next consumer confidence number. Monthly job growth will be the first Friday of every month. We'll start to see if the labor market starts responding and getting more in sync with the GDP side of things. And finally, I think the most important number will be the third quarter GDP number, which comes out on October 27th. So all in all, I think that at the end of the day, that we're looking at a seriously slowing economy during the remainder of 2022 and into 2023, with the prospect that we might see a mild recession in 2023. The key will be, when we see that recession, will the Fed immediately turn and spin policy around to try to re-stimulate the economy, or will they hold firm, allow the recession to work itself out, and put the economy into a better supply-demand balance point than we're currently in today? Okay, I appreciate your time and listening to this. And it's time for Artie to take over and ask questions that you have sent in on chat. Artie?
Yeah, thank you, John.
Yeah.
We're now moving to the Q&A portion. We have several questions that we've received so far. And as a reminder, you can still submit questions through the chats. So there's a few questions about the government's contribution to the size of GDP and how all of those policies may have been contributing to inflation and what state the economy would be in if the government did not do all those things.
Well, I think that I'm going to interpret the question a little bit. I think it's not the overall relative size of government in GDP, which is about 20% of GDP. It's risen a little bit over the past decade or so, but not significantly. It's what happened during COVID and the recovery from COVID and the amount of what essentially was monetized fiscal spending that took place. And that's really what led to the inflation that we're experiencing today. I think most economists will agree that the initial round of programs in March and April of 2020, a little over $2 trillion, was probably justifiable. It's the programs that came after that that were not. There was a fall 2020 program, which was basically a November election day referendum. Congressmen or women dare vote against another set of checks. And then again in February of 2021, we had another rescue plan. And those really, and again, they were, if Fed had not accommodated those programs, all right, and issued and bought up another $3 or $4 trillion of government debt, interest rates would have risen. The market interest rates would have risen, and that would have curbed the inflationary impact that those programs would have had. But unfortunately, that did not happen. The Fed accommodated that, and so the blame here is twofold, and that was a very dovish Fed that was willing to accommodate the fiscal policy excesses in late 2020 and early 2021.
Thanks, John. We talk about the CPI a lot. How does the producer price index play into this? Does it tell us anything different? And should we be using that to kind of think about forecasting inflation?
Good question. Yeah, the PPI until August was kind of tracking along at or slightly above where the CPI is. The CPI is consumer price index. It's a market basket of 400 goods that are weighted based on the purchasing behavior of urban consumers. And it's been around for years, and it is the accepted measure of inflation. Most cost of living adjustments in contracts, in labor union agreements, and for Social Security checks rely on the CPI as a measure of inflation. It's not the perfect measure, but it's the best measure we have. The producer price index is really measuring the wholesale set of wholesale prices, which may or may not be reflected immediately in consumer costs or consumer prices. And so I think that, the producer price index, as I said, up until last month, was tracking pretty steadily with this consumer price index. Last month, there was a disparity. The PPI came down quite a bit. I would not worry so much about that because, again, GDP is made up of 70% consumer expenditures. And so what consumers spend and the prices they face are the critical component in trying to determine inflation in our economy. So I'm pretty comfortable with using the CPI.
Thanks, John. Got a few questions about the effect of, say, housing cost pressures as a primary driver of recent inflation, and what the effect of all this is going to be on the housing market in general and in specific in Charlotte.
Specifically in Charlotte, yeah. Good question. I think that what housing costs have been rising at dramatic rates during this, beginning with the pandemic and subsequent, because of two issues. One is supply chain issues, where lumber has been scarce and been problematic. And the second has been labor. really have a problem with the workforce as well, and being able to get enough people. And so consequently, it has really been a cost push inflationary spiral, if you will, on housing, much more so than on the demand side. With all due respect to those $9,000 checks, that sum total checks, that's not going to make a big difference in the amount of house you purchase. What's been driving housing prices up is not the demand side nearly as much as the supply side. Cost issues, uncertainty, cost of supply availability, etc., has been driving housing prices up. On the cost side, you used to be able to build a house in 6 months. It's rare that a house, once started, gets built in less than a year at this point in time, primarily because of availability issues. And you know, just like cars, where we've seen, you know, Ford right now is sitting on 50,000 trucks in inventory they can't ship to dealers because they're missing parts, but they built them anyway. And they'll put the parts they're missing, mainly chips, in them as they come in. It's the same thing with houses. We've seen houses and apartments come online, missing appliances and a few other things unfinished, and yet people buy them and move in. It's really, as you know, on the housing side, it's really supply chain. I'm not worried about the housing market or housing bubble going forward, just to kind of elaborate on that, because we've not really seen a real buildup in overhang, if you will, in housing. Most of these houses are owner occupied houses. Very, very few are flip houses, which is the problem we had in 2008.
Thanks, Sean. We've got time for, say, one more question here.
Okay.
And I know in our own conversations, you talked a bit about the decline in productivity as a big important factor.
Mm-hmm.
Right. So if productivity is down and we have a lot of these flexible work arrangements now,
this is an Artie question. I can see this right now.
This is not an Artie question. This is an actual question from it's an Artie rearranging of words of the question, but it's a question from the chat.
You know, there are a lot of reasons why productivity has fallen. I think one of them is flexible working arrangements as well. But I don't think it's the primary. I don't think it's the primary cause of it. One of the things that, and we'll look at that. We'll, you know, talk about that. Back when COVID first started and everybody got sent home, and those that could work from home were working from home. For that first year, it looked as if, well, geez, we didn't see much of a productivity shift. In fact, in a lot of instances, when tracking workers' productivity, we saw an increase. Why was that? Well, you know, during 2020, there weren't a lot of alternatives. No restaurants were open, no gyms were open, no bars were open. There were no opportunity costs to working, and working occupied time, and it worked out fine. But as the economy started to reopen again, we've started to see working at home, remote working, two aspects to it. One, there are distractions and opportunities for your time in other areas, because now all those things are back open again. But also the second thing, I think we underestimate the interaction and what can happen when workers interact live around the coffee pot or around the coffee machine or whatever, and start talking about problems, face-to-face meetings where more information is shared than it is shared in Zoom meetings. And so, you know, I think that this is part of it. It's not the only part that's led to reduced productivity. Another big part is the real supply side shortage of workers, where companies are hiring people to do jobs that they're not trained for, and they don't have the expertise to do. So, you know, that's also a problem. But I think that, yeah, remote working is a problem.
Thanks, John. Thanks to all of you for joining us for the North Carolina Economic Forecast. We had a lot of great questions that we weren't able to get to today. And as we move forward, we invite you to save the date for the 2022 State of Housing Summit, scheduled for November 15th, for a comprehensive overview of the state of housing in Charlotte and examination of how the market has changed. Registration will open soon, and for those of you who had those housing questions, that's probably a great opportunity for you there. And then please make plans to join us for the next forecast and the release of the fourth quarter report on December 8th, and check our website soon for more information. To help us as we plan for future Belk College events and to be entered for a chance to win a Belk College gift pack, please complete our brief online survey by scanning this QR code. And that will conclude today's program, and we will see you all in December.